In this video, I'll be talking about paying off your mortgage very quickly, specifically paying off a 30-year mortgage in 5 or probably even 7 years, which cuts the time down by a lot and saves you a lot in interest payments. Now, there are already a bunch of videos on YouTube showing you how you can pay off your mortgage in a shorter time frame, and there are several different ways to approach this. However, most of these videos are very long, and then you have to watch each of these videos to get the different strategies. So in this video, I'll be making it very short and to the point, so you guys can get the idea behind paying off your mortgage in just about 5 years. Now, just before we go any further in this video, we'll be kicking this video off with a $100 giveaway for lucky winners, one winner each week off $25. And all you have to do for a chance to win is to drop a comment below, as we'll be selecting a random comment for a winner, and then hop on over to my website, link down below in the description, and subscribe with your email address, as that's how we'll be announcing the winners every single week. Also, a special shout out to all my returning subscribers. Thank you guys so much for tuning into the channel once again. I really appreciate all the support. And if you're new to the channel, my name is Ian, and on this channel, I talk about ways to make money, I talk about ways to save money, I talk about ways to invest your money, I talk about bank accounts and credit cards and everything to do with personal finance. So if you like these videos, be sure to give this video a thumbs up. I'll really appreciate it. It's 100% free, and it also helps the channel out a ton. Also, subscribe with all the notifications on so you never miss the updates of when I post new videos, which is every single day on this channel. So the method that I want to talk about today of paying off your mortgage or your 30-year mortgage in 5 years or thereabout is by borrowing money against the equity that you have in your home and then using that money to pay down on your mortgage. And I know this sounds a bit strange because you may be saying, well, why would I borrow more money to pay down debt that I already have if I'm going to have both payments at the same time? So here's how this actually works. So what you want to do is you want to understand how much equity you have in your home. So for example, let's say you bought a new home and you paid, let's say, $200,000 for that home, and you had that home for over 5 years. And over the 5 years of owning that house, the value appreciated by, let's say, 10%. This now means that the home is valued at $220,000. You now have an additional $20,000 in equity in this home. And let's say you made a 20% deposit when you were purchasing this house, meaning that you came in with $40,000 in equity from the very start. Now, with your down payment or your initial equity combined with the appreciation, you now have about $60,000 worth of equity in this property. This now means that you can go and apply for a HELOC, which is a loan against the equity that you have in the property. And in the HELOC, they'll give you 80% of the equity that you have available in your property. So in this example, you would get $48,000 in a home equity line of credit. Now, after getting this $48,000 in this home line of credit, you'll take all this money and you'll throw it at your mortgage, which lowers the timeline because you just paid down a huge lump sum on your mortgage. Now, this is also going to save you some money in interest payments as well. Now, also remember, the risk is if you don't repay this money, then your home is actually the collateral. So they'll take your home if you actually don't pay the money back that you took in this HELOC and you used it. So now that you've taken all this money and you've paid it down on your mortgage, what you want to do now is you want to take all the money that you get paid every single week or every single month, and you want to put it in this home equity line of credit, which is an account where you can move money in and out very freely. So every time you get paid, you put the maximum amount of your pay or all your paycheck into the home equity line of credit. Now, when you do this, you won't have any money to cover your living expenses. So what you can do here is you can use your credit card and pay for your living expenses, such as utility bills, your food, your groceries, shopping, mortgage, all that stuff. And the good thing about this is that you have around 21 days from the date of your statement to the due date to pay your credit card bill off. There's also usually a period of at least 14 days before the credit card statement is actually generated. So you have 30 or 30 plus days to spend before having to make any payments on your credit card. Now, let me just say before I go any further that this method is risky. If you either take money from the HELOC and you don't put it back, or you spend money on your credit card and you don't pay it before the due date, or probably you lose your job or all your streams of income, then this can get really messy for you. So there are risks with this method, but if you can actually pull this off, then you'll save a lot of money, especially in interest payments. You can still pay your mortgage off very early. So follow along in this video so you can get the entire concept here. Now, you may be saying, Ian, well, if I put my entire salary into the HELOC and then I put my expenses on a credit card, when it's time to pay the credit card bill, what money will I use to pay that credit card bill? And to pay your credit card bill in full, you simply take money from the HELOC, you pay your credit card bill, and then when you get paid, you again take your entire salary and you put it in the HELOC, and you rinse and repeat this every single month. Now, for you to pull this off successfully, your income has to be higher than your expenses. So for example, if you get paid $10,000 every month, your expenses need to be, let's say, $8,000 every month or less. And this way, even though you're putting your full salary in the HELOC and then taking money from the HELOC to pay off the credit card, you're still paying off around $2,000 or adding $2,000 to that HELOC every single month. Also, you want to do it this way because the HELOC is actually going to charge you interest based on your daily balance. And this is why you want to put the maximum amount of money that you can in the HELOC at all times and keep most of the money in there for longer, because you'll get more favorable interest terms because your daily balance in the HELOC will be a lot higher. Now, another spin-off effect is that on the credit card that you're using, hopefully you have a high rewards credit card, and this means that you'll be getting a lot of cash back, or at least rewards points, on all the things that you're purchasing, and that way you're also benefiting from using that credit card as well. So it's all about leveraging debt to pay off your mortgage early and getting a lower interest rate or paying less in interest overall. Now, there are some risks with this method, and I mentioned some of these earlier on, and this is that the HELOC comes with an interest rate that is not set. So this interest rate could go up, it could go up by a lot, and maybe if it goes up, then you wouldn't be able to make the payments just as you were making them initially, and that would mess up this entire thing. And also, if you lose your job or your income streams, then this would fall apart very quickly. So there are some risks with this method. And also, if you don't have good credit or a good credit score, then you probably won't be approved for a HELOC with favorable terms in the first place. And if you're not able to make the payments on the HELOC, then they could take your property. So this is a good way to pay off your mortgage very early and save on some interest payments. However, it is very risky. In my opinion, I wouldn't do this myself. Now, I know some of you guys may be interested in doing it, or some of you guys may have already done this before. If that's the case, comment below and let me know how this worked for you. But instead, I'd rather just make extra payments on my mortgage and make those payments when I can, instead of doing it this way, because this is very, very risky. Now, if you're wondering why anyone would pay off their mortgage early, or if it's actually worth it, you can use a simple mortgage calculator. So for example, let's say you took a $200,000 loan for a house and you got the loan with the terms of 30 years with a 4% interest rate. You would have paid a total of $343,000 for that home, and the total interest that you paid over 30 years would be over $140,000, which is a lot of money. So you're almost paying time and a half for this house. However, if you were to simply add $100 to your mortgage payment every single week, which would be $400 every single month, by doing that, you would save 13 years off your mortgage, or pay off your mortgage in 17 years, and the total interest that you would pay would be $75,000, as opposed to $143,000 if you were just to make the regular payments on your mortgage. So you can visit one of these mortgage calculators and you can put the numbers in and see how much money you could contribute to your mortgage every single month or every single week, and how many years it would save you, and also how many thousands of dollars it would save you in interest payments on the mortgage over that 30-year period. So let me know what you guys think about this. What would you rather do? Would you go with the HELOC, or would you just try to pay your mortgage off by adding extra payments to your mortgage every single week or every single month? And then comment below and let me know your thoughts. As always, thanks for watching. Give this video a thumbs up if you like the content. Also subscribe so you never miss any of the updates, and be sure to check the links down below in the description where you can get free and helpful stuff. And as always, all the best, and I will see you guys tomorrow in the next one.